In the 1600s, the Dutch East India Company owned and operated hundreds of ships that traded gold, porcelain, spices, and silks around the globe. However, running such a massive operation was not cheap. In return for a share of the ship's profits, the company turned to private citizens who invested money to fund their expensive voyages. This practice allowed the company to afford even more luxurious journeys, increasing profits for them and their investors. The Dutch East India Company unknowingly created the world's first stock market when it sold these shares in coffee houses and shipping ports across the continent. Since then, fundraising companies have been raising money from willing investors for a variety of businesses. Today, many schools, careers, and even television channels are dedicated to understanding the stock market. But the modern stock market has become increasingly complex since its inception. So how do companies and investors make use of the market today? Let's imagine that a new coffee company launches on the market. First, the company will market itself to big investors. They get the first crack at investing in a good idea when the company's initial public offering, or IPO, takes place. The company is now launched on the public market, where any company or individual who thinks the business could be profitable can buy a stock. By buying stocks, investors become partial owners in the business. Their investment helps the company prosper, and as it gets more successful, more buyers may see potential and buy stock. The cost of those stocks will increase as demand increases, forcing prospective buyers to pay more and pushing up the price of the company's stocks already owned by people. The increased interest will help fund new initiatives for the company and boost its overall market value by showing just how many people are willing to invest in their idea. However, if for some reason a company seems less profitable, it can also be the reverse. When investors think their stock's value is going to decline, they'll sell their stocks so they can make a profit before the company loses more value. As stocks are sold and the demand for the stock drops, the stock price falls and the company's market value decreases. Investors could be left with large losses if the company does not start looking profitable again. There are many factors that affect supply and demand. Companies are adversely affected by the effect of market forces, such as the fluctuating price of materials, technological changes, and the changing cost of labor. Investors might be concerned about leadership changes, bad publicity, or changes in trade policies. Of course, there are plenty of investors who are simply ready to sell valuable stocks and pursue personal interests. All these variables create day-to-day noise in the market, which can make companies appear more successful or less successful. In the stock market, appearing to lose value often results in investors walking away, and in turn, the stock loses value. Market confidence has the power to cause everything from economic booms to financial crises. And this hard-to-track variable is why most professionals recommend long-term investing over trying to make quick money. Despite this, experts continue to build tools in order to increase their chances of success in this highly unpredictable system. The stock market, however, isn't just for the rich and powerful. With the dawn of the internet, ordinary people can buy stocks the same way that large investors do. And as more people learn about this complex system, they too can participate in stock trading, support the companies they belong to, and achieve their financial goals.